Greetings and salutations to everybody returning to the channel. Wishing you everyone a wonderful day. Please subscribe and follow if you haven't done so before. Prior to its widespread adoption, this channel provides you with accurate crypto intel. Almost no one is seeing what's happening in this market, yet something spectacular is happening right now. Institutional capital is subtly positioning itself amidst the chaos of panic timelines, red candles, and bear market narratives. There has seldom been such a large gap between public opinion and financial flows, and in the past, such a gap has always heralded the start of a new era. Because surface-level disorder is often an indication of transition at the macro level, we need to take a step back and look at the big picture. 5 consecutive red months have been printed by crypto during the previous several months. After October, November, and December, January will also end in the red, unless a major event occurs. Weaknesses are perceived as such on social media. According to retail psychology, this proves that the cycle has ended. Contrary to popular belief, markets are rational. Market forces, strategic positioning, and government oversight propel them. This very pattern has happened previously. 5 months in a row in 2014 saw the market close in the red. Feelings plummeted, legends faded away. Participants were exhausted when they left. It was hardly a protracted decline that ensued. There had never been a recovery expansion like it in the early days of cryptocurrency. We had 6 months in a row with negative numbers in 2018. To me, that was the end of an era. Yet, in the subsequent cycle window, Bitcoin recovered from those lows and achieved a 300% expansion. You can't call it a mystical pattern. The structure is there. Extending red sequences wear down vendors. Decent hands go out. Over time, wealth builds up. Precipitation falls. As a result of the stealth absorption of supply, liquidity returns and prices reprice strongly upward. At the moment, that dynamic is being reinforced by on-chain data. Exchanging funds is at a high level. Cold storage is becoming the new normal as coins leave trading platforms. Doing so does not constitute speculation. We call that positioning strategically. Assets lose some of their liquidity as they leave exchanges. Asymmetric upward pressure is created by less float in a future growth of liquidity. Despite widespread panic, the market is yelling accumulation. That difference is significant. After that, at a macro layer, we are seeing a stabilization of global liquidity conditions. The stance of aggressive tightening by central banks is giving way to a more neutral stance. No longer is restrictive pressure being accelerated by the dynamics of U.S. Treasury issuance, global M2 developments, or forward expectations on rate policy. Coin prices do not fall when market mood rises. When liquidity begins to improve, it reaches its lowest point. We have entered the time of transition. The next step cannot be unlocked by macro liquidity alone, though. Laws and rules do. U.S. cryptocurrency regulation has been murky for a long time. Fiduciary obligations govern how institutions function. They are unable to invest funds into assets whose legal categorization is unclear. Financial markets do not function in a haze. At this point, the Clarity Act is crucial. Digital assets are intended to be defined within established legal categories under the Clarity Act. It differentiates between assets and financial products. I know it sounds procedural, but that is really fundamental. Regulatory jurisdiction becomes predictable after classification is established. It is possible to construct compliance frameworks. Institutionalization of custody standards occurs. The bill was passed by the House with unanimous support from all parties. Things are moving along in the Senate. Top regulators have openly indicated that a settlement is in the near future. This does not constitute idle speculation. Progression in legislation is what it is. Institutions will no longer be exposed to existential regulatory risk when they invest capital. When clarity is established, they shift. Additionally, institutions do not make an enthusiastic announcement when they make a change. They carry it out using filings. Here is where XRP becomes relevant, because institutional XRP-related products are up and running with funding and expansion plans, even as the retail narrative is debating whether a bear market has begun. Over the course of its regulated ETF structure, Franklin Templeton amassed more than 118 million XRP, which it then traded on the New York Stock Exchange, NYSE, under the symbol XRPZ. By the end of the year, the value of the allotment was close to $2 billion. This is not a demand in theory, regulated exposure that is openly discussed. Capital from institutions does not follow trends. It raises awareness before the momentum comes back. In a public display of their belief in XRP and Solana as components of the upcoming digital infrastructure cycle, Purpose Investments of Canada established both of these assets as exchange-traded funds, ETFs. CoinShares is still working on the structure for their spot ETF. The leveraged XRP product launch date was advanced by volatility shares. They are not ancillary service providers. Investing within the bounds of regulatory compliance, they are regulated asset managers. Finally, we get to the heavyweight. T. The active crypto ETF that includes XRP exposure was filed for by Roe Price, which manages over $1.8 trillion in assets. Companies of that size use strategic planning when they develop product frameworks. They take their experiments very seriously. The time for regulatory responses is drawing near. The product launch has the potential to attract institutional investors at a rate that individual investors do not yet anticipate if it is given the go light. When BlackRock's Bitcoin ETF was approved, we saw this dynamic in action. The majority of retail players didn't have time to completely absorb the structural shift before prices started to reprice. The composition of liquidity is affected by institutional access. The structure of prices is affected by the content of liquidity. Envision now, in a regulatory landscape with more clarity, that fundamental change applied to both Bitcoin and XRP. This is the situation that is taking shape behind all the din. Exaggeration has no place here. The topic is plumbing. The capital markets necessitate a system of product packaging, classification, and custody. For categorization, there is the Clarity Act. Coverage is offered by ETFs. Institutional-grade security is provided by custodians. Funds that have been sitting idle for a while now have the green light to be allocated whenever those factors come together. Everyone looks at the candles. Corporations put their money into building things. Additionally, the infrastructure is almost finished. For the cryptocurrency market as a whole, what does this mean? Because the retail sector will not spearhead the next phase of cryptocurrency. The focus will be on the balance sheet. Retail speculators and early adopters propelled the initial cycles. Pension funds, endowments, sovereign allocations, and asset managers looking to diversify in a digitalizing financial system will fuel the next cycle. Once a theory, tokenization is now a reality. Blockchain settlement systems are being developed by major financial organizations. There has been a worldwide expansion of stablecoin systems. Digital currency architecture is being investigated by governments. The infrastructure of the capital markets is moving in the direction of blockchain technology. Speculation in narratives is giving way to crypto's practical use in finance. Assets that are compatible with institutions and have clear regulations stand to gain the most in such a setting. XRP is situated right at that crossroads. Institutional settlement efficiency and cross-border liquidity were its guiding principles. The United States had a slowdown in adoption for a long time due to regulatory uncertainties. That cloud is starting to lift. With XRP's use case confirmed, there is no longer any existential compliance risk, and its value becomes precious. How it is modeled by institutions is affected by that. Speculative gain is not the focus of the institutional perspective. It pertains to the distribution of infrastructure. Digital infrastructure, which includes blockchain-based settlement networks, is a central tenet of the AI, energy transition, emerging market, and large asset manager portfolio construction thesis. To participate in thematic allocation models, XRP must first be classified as a bridge asset inside regulated frameworks. The influx into XRP as compared to its market capitalization is substantial, even when only a fraction of the multi-trillion-dollar asset pools are considered. Repricing markets does not necessitate full capital commitment. All it needs is a little tilt. Once regulations are clear, diversified institutional portfolios might see an allocation movement of 0.25%. The incremental demand might be in the billions as a result of that small reweighting. The demand-side component of convex price dynamics emerges in a context of constrained liquid supply. Look at the regulatory side of things now. The SEC and the CFTC's vagueness caused hesitancy for a long time. Company launches were hesitant. Assets were hesitantly held by banks. Caution was suggested by compliance departments. Legal tail risk is mitigated by clarity. Compliance frameworks can be standardized once classification is finalized. It is possible to formalize audit structures. It gets easier to underwrite insurance. The derivatives market is getting deeper. Liquidity is born from depth. When funds are readily available, they foster peace and security. Greater engagement from capital is a byproduct of stability. Markets develop via organization, not emotion. Thus, the Clarity Act takes precedence over fluctuations in prices in the near run. The immediate future is what we need to clarify. Relief rallies typically follow protracted red monthly sequences from a technical standpoint. Bounce dynamics are created when oversold conditions are coupled with improving liquidity. Looking at Bitcoin's historical cycle behavior, it seems that the cryptocurrency is finding structural support near key psychological levels. When Bitcoin finds a stable price and gains momentum again, altcoins often react by amplifying their beta levels. During risk-on transitions, XRP has a history of displaying explosive catch-up moves. Capital looks for assets with strong narratives and structural catalysts when liquidity shifts away from Bitcoin's dominance. Both are currently held by XRP. The narrative strength is created by institutional product introductions. Clear regulations serve as a stimulus for structural change. When people are feeling down, that combination doesn't usually work. There will be continued short-term volatility. The market does not make a smooth transition. Doubts will arise. Some steps back will be necessary. However, the imbalance is changing. Beyond pricing targets, the long-term perspective spans. Crypto market capitalization as a whole would grow substantially if Bitcoin even partially realized its ambitious long-term predictions. There will be an imbalance in the flows captured by assets that are part of institutional frameworks in this setting. With regulatory normalization and XRP's incorporation into ETF structures, the likelihood of long-term institutional investment, as opposed to short-term speculation, rises. This distinguishes hype cycles from adoption cycles. Return to the psychological component of the equation now. The market is weary. Those who invested close to the market peak have given up. Engaged users have become less active. The media's attention has faded. In the past, that's where structural buildup has taken place. Organizations do not seek happiness. Indifference allows them to grow. Sums of money moving freely over the counter recently point to accumulation avenues that sidestep spot volatility. That is the way most institutions act. To keep prices from being distorted, large orders are placed off exchange and then stored until the product is made public. Red candles are seen in retail. Discounted entry points are available to institutions before to regulatory unlock. This difference won't last forever. Reactions will change swiftly as news about ETFs moves from lawsuits to adoption. The price will have changed by the time the story is reframed by mainstream media. That is how reflexivity works. Headlines follow liquidity. The headlines entice late liquidity. The issue is not with the continuation of volatility in the near future. Yeah, it's going to. Whether or not fundamental forces are converging under that volatility is the key question. All the necessary components are there when seen at a macro level. Stabilizing liquidity, advancement in regulation, product structures for institutions, currency supply decreases, depletion of emotion. At the very top of the market, that combination is very rare. Asymmetric opportunity lives at transitions, and it seems to be near transitions. Let's make this crystal clear. Participants have learned to anticipate the persistence of discomfort after 5 consecutive red months. Based on past events, it appears that the inverse frequently occurs after compression stages. Coins are moving into long-term storage, according to on-chain data. Tradable supply is lowered as a result. The goal of codified regulatory definitions is being advanced by the Clarity Act. That clears up any legal gray areas. Products tied to XRP have already been developed or filed for by major asset managers. That proves the goal of the institution. All of these factors taken alone are positive. They constitute a structural pivot when used together. Immediate vertical price expansion is not guaranteed. As a general rule, market movements are not linear. However, the distribution of outcomes probabilities in the medium to long future is significantly altered. It is from a place of disbelief that the strongest rallies arise. People couldn't believe it was 2014. By 2018, I was completely worn out. During the recovery phases, the returns were far higher than the risk that was perceived during the low points. Both eras are reflected in the modern surroundings. Adoption by institutions is subtle, a procedural matter. Statements of capital allocation, custodial partnerships, approvals, and filings all contain it. Retailers eagerly await official word. Organizations take chances. After more ETFs are launched and regulations are clarified, XRP will go from being an asset that is fought to an integrated financial instrument. Because of such change, its pool of potential investors grows substantially. Funds that were previously unable to take part because of mandate constraints are now able to do so. Valuation frameworks change as access grows. The analysts start to model the utility of the network. The benefits of correlation are being evaluated by portfolio managers. The hedging products are being built by the derivatives desks. there is an increase in liquidity. Because of the potential structural compression of volatility at that point, conservative allocators may find the asset more appealing. Markets develop in this way. In the near future, Bitcoin might form a base before moving into more favorable consolidation areas. Beta reactions for altcoins could be higher after that. Looking at ETF flows becomes the key statistic in the medium term. Prior to more extensive institutional reallocation, early inflow acceleration is common. In the long run, assets placed under frameworks for regulatory clarity will no longer be considered speculative outliers, but essential components of traditional financial architecture as digital assets continue to integrate. Optimism is not the issue here. The key is to identify the sites of structural inflection. One is on the horizon. It is possible for repricing to happen more quickly than consensus anticipates when laws are in sync with capital strategies and infrastructure. Doubts will arise. Unpredictability is inevitable. The reacceleration phase, however, can feel abrupt after capital flows have grown significantly. Additionally, the disparity diminishes if retail becomes at ease. That is the significance of times like these. Reason being, structure is subtly shifting, not because pricing is thrilling. Historically, cycle winners have been determined by their positioning during structural change. Having social approval is not a prerequisite for financial success. It plans to scale as liquidity allows, raises exposure through compliant vehicles, and anticipates regulatory resolution. It is happening right now, and we are seeing it all. Participation is entirely up to the individual. It is still crucial to manage risks. Maintaining strict allocation policies is essential. In macro cycles, however, it has seldom paid off to disregard structural alignment due to pessimistic attitude. Be mindful of the movement of money. Keep an eye on the laws. Be mindful of new product announcements. At some point, the price will reflect these.